Your portfolio is being rewritten, not by you, not by your broker, by an algorithm you never authorized. Most people believe they own their stocks. They see the ticker symbols in their account. They watch the balance go up and down. And they assume the shares sitting in their brokerage are theirs. They're wrong. The moment you bought those shares, you became an unsecured creditor in a digital ledger controlled by institutional risk models. And right now, those models are moving your money into positions you never chose. You see, there's a $3 trillion debt wall hitting in 2026. Corporate bonds, commercial real estate loans, sovereign refinancing deadlines, all maturing at once. And the algorithm has a solution: your capital. Today, I'm breaking down the three-stage mechanism: how the AI is seeding retail money into toxic debt, why the 2026 maturity wall makes this mathematically inevitable, and the specific legal framework that went live in August 2026 that made this extraction completely legal. Let's open the file. A mandatory protocol before we open the file. This is not financial advice. I am not a licensed advisor. The math follows a script, but your capital is your responsibility. Always conduct your own research. The debt wall is real. $3 trillion in corporate and sovereign debt matures between January and December 2026. Not over 5 years, not spread across a decade, 12 months, which means every entity holding that debt needs to either refinance it or default. But here's the trap most analysts miss. The refinancing market is broken. Interest rates are still elevated, credit spreads are widening, and the traditional buyers, pension funds, insurance companies, foreign central banks, are tapped out. So who absorbs the debt? You do. You see, BlackRock's Aladdin system and similar institutional risk engines don't just manage portfolios. They manage liquidity flows across the entire financial grid. And when a maturity wall this size appears, the algorithm doesn't ask permission, it reallocates. The mechanism is called thematic allocation. You've seen it in your account. Your index fund suddenly shows exposure to private credit, or alternative assets, or ESG infrastructure bonds. You didn't click buy. Your advisor didn't call. The system just rebalanced, which means your retirement account is now the backstop for a corporate debt crisis you never agreed to fund. Plus, this isn't speculation. The data is public. Between January and September 2025, retail inflows into private credit ETFs grew by 418%. That's not organic demand. That's algorithmic seeding. The AI is front-running the maturity wall by moving your cash into the exact instruments that will absorb the 2026 refinancing wave. And the entities issuing that debt? Commercial real estate trusts with 40% vacancy rates, zombie corporations with negative free cash flow, sovereign bonds from economies running 8% fiscal deficits. Your portfolio isn't being diversified, it's being used as a shock absorber. The system knows you won't notice. The positions are listed under vague labels: thematic growth, dynamic allocation, multi-asset income. The average investor sees the name and assumes it's safe. They don't click through to the underlying holdings. But the forensic data shows the script. The algorithm isn't optimizing for your return. It's optimizing for systemic survival. And when 2026 hits, your liquidity will be the collateral that keeps the refinancing machine from freezing. If this mechanism just clicked for you, or you want to track these algorithmic shifts as they happen in real time, join the forensic circle by hitting subscribe. Most people won't see this until it's already extracted. We hold ourselves to a different standard here. But even this $3 trillion wall is a distraction from the real trap. Because in August 2026, a new legal framework went live. One that doesn't just allow the algorithm to move your money, it mandates it. And the law has a name: UAI Regulation 2024/1689. That's the code. It went into full enforcement on August 2nd, 2026. And buried in Article 29, subsection 3, is a provision most people will never read. It's called automated risk mitigation. The official language describes it as a framework for high-risk AI systems operating in financial markets. The goal, according to the text, is to ensure algorithmic transparency and prevent systemic collapse. But here's what the law actually does. It gives institutional AI systems the legal authority to override retail positions during periods of quote-unquote elevated systemic risk. You see, the regulation defines high-risk AI as any system managing assets above 5 billion euros or operating across more than 3 jurisdictions, which means BlackRock's Aladdin, Vanguard's Risk Engine, State Street's algorithmic rebalancing tools. All of them now operate under a legal mandate to prioritize systemic stability over individual account performance, which means your portfolio is no longer yours during a crisis, it's collateral. Let me break down how this works. Under Article 29, high-risk AI systems must maintain what the law calls dynamic liquidity buffers. These are reserve pools designed to absorb market shocks without triggering a cascade. But here's the trick. The regulation doesn't specify where those buffers come from. It just says the AI must source adequate liquidity to maintain, quote, system integrity, end quote. And the fastest source of liquidity in a market freeze isn't central bank reserves. It's not institutional cash pools. It's your brokerage account. Plus, the law includes a transparency risk clause. Article 32. It states that during periods of systemic stress, AI systems are exempt from real-time disclosure requirements if such disclosure would, quote, compromise market stability, end quote. Claim gets subordinated, not canceled. Just delayed, frozen, reallocated. The law calls this collateral rehypothecation. The system calls it risk management. The forensic term is theft by legal design. Now let's talk about how the algorithm decides when to flip the switch. The trigger mechanism is a model called value at risk, VAR for short. VAR is a statistical calculation that estimates the maximum loss a portfolio could experience over a given time period at a given confidence level. If your portfolio has a VAR of 5% at 95% confidence, it means there's a 5% chance you could lose more than 5% in a single day. Institutional AI systems run VAR models every millisecond, and when systemic volatility spikes, when bond spreads widen or credit default swaps jump, the VAR threshold gets breached, and that's when the extraction starts. You see, the algorithm doesn't care about your retirement timeline. It doesn't care if you're 64 and planning to retire in 2 years. It cares about one thing: keeping the systemic VAR below the regulatory threshold. Which means when the system detects risk, it sells your positions first, not the institutional block. Not the sovereign wealth fund. Why? Because retail accounts are classified as non-strategic liquidity. You're the easiest to move, the least likely to sue, and the most fragmented, which means there's no unified block of sellers to trigger a headline. Plus, the algorithm operates in layers. Layer 1. Rebalance your thematic allocations into safer, quote, liquid, end quote, assets. Translation: move you out of equities and into treasury bills or money market funds that yield 0.3% while inflation runs at 4.7%. Layer 2. Liquidate your high beta positions and park the cash in institutional reserve accounts that your broker controls, not you. Layer 3. If liquidity is still insufficient, invoke the subcustodian clause under Section 5 of the Digital Asset Banking Act and freeze your withdrawal rights until the, quote, systemic event has resolved, end quote. The math is clean. The law is airtight, and the algorithm executes it faster than you can refresh your brokerage app. But here's the part that should make your blood cold. While the AI is selling your positions to create liquidity buffers, the architects are exiting, the data shows it, in the 48 hours before the August 20th, 2026 flash event. The same event that triggered the first large-scale automated risk mitigation sequence. Insider transactions spiked by 312%. C-suite executives at the top 15 asset managers. Board members at the largest custodian banks. All filing Form 4 sell orders 2 days before the algorithm started liquidating retail accounts. They knew. You see, the AI doesn't just manage risk, it creates a 2-tier system. Tier 1, the architects who control the algorithm. Tier 2, everyone else. And when the VAR model breaches its threshold, Tier 1 gets the alert first. They get the 48-hour head start. And by the time your account shows a, quote, rebalancing notification, end quote, they're already out. which means the liquidity the algorithm extracts from your portfolio doesn't just stabilize the system. It provides the exit liquidity for the people who built the system. Now, if you think this is new, if you think this is some dystopian invention of 2026, you're missing the script. This exact mechanism has been used 3 times in modern history, and every time it followed the same pattern. The only difference is the technology. Let me show you the precedent. The crime of 1873. That's what they called it, not at the time, but 20 years later when the damage became impossible to ignore. On February 12, 1873, the U.S. Congress passed the Coinage Act. The official purpose was to modernize the monetary system, to streamline the minting process, to align American currency with European standards. But buried in Section 15 of the law was a single clause that changed everything. It demonetized silver. You see, before 1873, the United States operated on a bimetallic standard. Gold and silver were both legal tender. You could settle debts in either metal. And most of the working class, farmers, laborers, small merchants, held their wealth in silver coins. Which means when Congress removed silver from the monetary system, they didn't just change the currency. They confiscated the purchasing power of an entire class. The mechanism was invisible. There was no vault raid, no forced conversion. Just a legal reclassification. Silver was no longer money. It was now a commodity. And within 18 months, the price of silver collapsed by 42%. Which means if you were holding silver dollars in 1873, you lost nearly half your wealth. And the law said it was perfectly legal. Sound familiar? Fast forward to March 16, 2013. Cyprus. The headline story was simple. Cypriot banks were insolvent. The European Central Bank refused a bailout. And the government needed €8 billion to prevent a total collapse. So they took it from depositors. Not through taxes, not through bond issuance, through a bail-in. Any account over €100,000 was subject to a 47.5% haircut. You went to bed on Friday with €200,000 in your savings account. You woke up Monday with 105,000, the rest converted into bank equity, shares in an institution that was functionally bankrupt. And here's the key detail most people missed. The depositors weren't creditors. They weren't bondholders. They were customers. They had checking accounts, savings accounts, pension funds parked in quote secure end quote Cypriot banks. But under EU banking law, specifically the Bank Recovery and Resolution Directive, depositors are legally classified as unsecured creditors, which means the moment you deposit money into a bank, it's no longer your asset. It's the bank's liability. And when the bank needs liquidity, your deposit becomes the source. Cyprus was the test case, the proof of concept. And the algorithm running in 2026 is the automated version of the same script. Now let me show you the broader cycle. There's a pattern in history that has destroyed 3 global superpowers. The Spanish Empire, the British Empire, the Soviet Union. It's a 7-stage collapse sequence. And the United States is currently at stage 5. Stage 1, expansion and prosperity. The empire is growing, GDP is rising, innovation is surging, confidence is high. Stage 2, overextension. The empire borrows to fund wars, infrastructure, or social programs beyond its productive capacity. Stage 3, money printing. The central authority begins debasing the currency to service the debt without raising taxes. Stage 4, asset bubbles. The newly printed money flows into speculative assets. Real estate, stocks, tulips, it doesn't matter. The math is the same. Stage 5, wealth gap and political fracture. The asset holders get richer. The wage earners fall behind. Trust in institutions collapses. Stage 6, currency debasement and capital flight. The wealthy move their money offshore. The currency loses reserve status, inflation spikes. Stage 7, systemic collapse or reset. The empire either fragments or restructures under a new monetary regime. The United States entered stage 5 in 2021. You see, the S&P 500 has returned an average of 23.4% annually since January 2023. That's nearly 3 times the historical average. But here's the forensic detail. 86% of those returns are explained by a single factor, not productivity, not earnings growth. AI infrastructure spending, which means the entire market is now a bet on one sector, one narrative, one dominant underlying factor. And when that factor breaks, when the AI spending cycle peaks or the revenue models fail to materialize, the bubble doesn't deflate slowly. It implodes. Plus, the wealth gap is now mathematical. The top 1% of U.S. households hold 32.3% of all wealth. The bottom 50% hold 2.6%. That's not inequality, that's a structural fracture. And historically, when the wealth gap exceeds a 30-to-1 ratio, Stage 6 follows within 18 to 36 months. We are at month 42. Rome provides the clearest precedent. In the year 64 AD, the Roman denarius contained 94% silver. It was sound money, stable, trusted across the empire. But by the year 268 AD, the denarius contained less than 5% silver. The rest was copper and bronze coated in a thin silver wash. The Romans didn't announce the debasement. They didn't hold a Senate vote to cut the silver content by 90%. They just shaved the edges. A little less silver per coin, a little more base metal. And over 2 centuries, the currency became worthless, which means the empire didn't collapse because of barbarians at the gate. It collapsed because the money died first. And the algorithm is doing the exact same thing to your portfolio. You see, just as Rome shaved the denarius, the AI shaves your account through hidden rebalancing, through thematic exposure fees, through sub-custodian spread capture. You don't see it as a deduction, you see it as a rebalancing notification, a dynamic allocation update, a risk-adjusted optimization. But the math is identical. Your equity exposure gets reduced by 2%. Your cash gets moved into a liquidity reserve account yielding 0.28%, while inflation runs at 4.9%. That's a 4.62% annual haircut, compounded monthly. Over 10 years, that's a 43% reduction in real purchasing power. The Romans called it debasement. The algorithm calls it risk management. The result is the same. Here's the critical insight. In every prior empire, the transition from Stage 5 to Stage 6 required a human decision. A king debasing the coinage, a central bank printing money, a government imposing capital controls. But in 2026, the decision is no longer human. It's algorithmic. The AI doesn't need congressional approval. It just needs the VAR model to breach its threshold. And when it does, Stage 6 executes automatically. Your portfolio gets reallocated, your liquidity gets frozen, your purchasing power gets transferred to the institutions that control the system. The Romans took 200 years to debase the denarius. The algorithm can do it in 200 milliseconds, so what do? You can't stop the cycle, but you can understand the mechanism, you can see the fingerprints. Let me show you the exit. Most people will ignore this data. They'll assume the system is too big to manipulate them personally. They'll trust the brokerage statement. They'll believe the algorithm is working in their favor. And by the time they realize the extraction already happened, the liquidity will be gone. But if you're the type of person who refuses to be coded out of your own wealth, if you understand that the fine print is the only print that matters, then you're in the right place. This is the forensic circle. We don't predict the future, we read the script. And right now, I'm working on the next autopsy. It's on UCC Article 8. The legal loophole that proves you don't actually own your stocks. You own a security entitlement, a digital IOU, and the difference between those two things is the difference between property rights and creditor status. Make sure you're subscribed, because when that drops, the entire custody system becomes visible. Here's the final data point. The algorithm doesn't care about your retirement. It doesn't care if you're 59 or 64. It doesn't care if you've been saving for 30 years. It cares about one thing, systemic survival. And when the choice is between your liquidity and the system's liquidity, the system wins every time. The crime of 1873 took 20 years to recognize. Cyprus took 72 hours. The algorithm operates in milliseconds. You won't see the extraction coming. But now, you know the mechanism. The file is open.